Welcome to the deep dive. We sift through the sources, connect the dots, and give you the essential knowledge. Today, we're tackling a term that, let's be honest, sounds pretty dramatic. Offshore banking. You instantly think secret vaults, maybe spies.
Right, James Bond definitely comes to mind. Tax havens, hidden money, maybe some shady dealings. But that's exactly what we want to push past today. Our mission, based on the sources we've gathered, is to understand what offshore banking legally involves. What's it actually for in the real world? And how do these specialized banking units, these OBUs, actually function? We're looking at the legal side, the compliance, the nuts and bolts.
Exactly, because the material makes it crystal clear. There's a huge gulf between using offshore accounts legally, say, for asset protection or diversifying investments, and using them illegally for tax evasion or laundering money. You absolutely have to know where that line is. Okay, let's unpack this. All right, first things first. What is offshore banking, fundamentally? Forget the tropical island images for a second.
At its most basic level, it just means opening a bank account in a country that isn't your home country. That's it. People do it for a few main reasons, typically. Protecting their assets, seeking greater financial privacy, or sometimes, for potential tax advantages.
And that word offshore, it's really misleading, isn't it? Our sources stress this point.
Totally misleading. It doesn't have to be an island like the Bahamas or the Caymans, though it can be. Offshore could just mean driving across the border to open an account in, say, Canada if you're in the US, or Mexico. It's about the legal jurisdiction, not the geography.
Okay. And you mentioned privacy and asset protection. There's also this myth that it's only for the fabulously wealthy.
Yeah, that's another common misconception the material debunks. Well, sure, some banks target high net worth individuals with big minimums.
Yeah.
Others are surprisingly accessible. Some foreign banks apparently let you open an account with like $1 or maybe a few hundred. It really varies.
But there's a flip side to that, isn't there? Compliance costs.
Oh, absolutely. Some foreign banks actually avoid clients from certain countries, especially the U.S. Why? Because the regulatory burden tracking, reporting under laws like SANSI, it's just too expensive and complex for them. The potential profit isn't worth the hassle or the risk.
So that accessibility varies wildly, which brings us right to the crucial point. Legal versus illegal. When is it okay?
It's legal when you're doing it for legitimate reasons. Things like diversifying your investments geographically, maybe you own property abroad, or you run an international business, or a big one these days, protecting your safety.
But absolutely make a break.
Compliance. Full stop. You
Yeah.
have to fully comply with all the tax laws and reporting requirements in your home country. Declare the account, report the income.
So it only crosses the line into illegality when you don't do that, when you're actively hiding money.
Precisely. Using accounts to conceal income or assets from your tax authority, failing to file the required reports, or, obviously, if the money itself came from illegal activities, that's money laundering. Open the account, tell your government. Legal, hide it. Crime. Simple as that, conceptually.
Okay, so it can be a legitimate tool. Let's talk about the appeal then. Why bother with the extra paperwork and complexity? History plays a role, I imagine.
A big role. You can't talk about this without mentioning the classic Swiss bank account, right? Famed for its historical secrecy and privacy laws, that made Switzerland a magnet for people wanting to shield assets, maybe from messy divorces, lawsuits, unstable governments, or, yes, historically from tax collectors.
But the sources are really clear that era of near-total banking secrecy is basically over.
Oh, it's fundamentally changed. Global pressure, international agreements.
all.
They've transformed everything. Switzerland, for example, now automatically shares account information with many foreign governments. So that specific kind of tax evasion associated with secret Swiss accounts, largely a thing of the past, it's about regulated privacy now, not hiding.
Okay, so secrecy is out. What about other appeals? Tax treatment is still mentioned.
Yeah, that's still a factor. In many countries, if you're a non-resident, you might not owe capital gains tax in that country on your investments held there. It's a legal benefit in that jurisdiction. But, crucially, you almost certainly still owe tax on that income back in your home country. You just have to report it.
So maybe a secondary benefit. What's the main driver then, according to the material?
Stability. Over and over, the sources emphasize this. For many people around the world, especially those in politically or economically volatile regions, the biggest fear is asset seizure or the collapse of their home country's financial system. So, putting money into perceived stable nations, Switzerland, Singapore, the UK, even the US, it's about preservation. It makes it harder for their home government to just take their money.
And that leads to maybe the most surprising point I found. the U.S. itself being a major destination. We think of money leaving the U.S. for offshore havens.
It's a fascinating paradox, isn't it? The U.S. government has aggressively pursued offshore tax evasion by its own citizens. But for foreigners, the U.S. offers incredible stability. And certain states, like Nevada, Wyoming, South Dakota, have laws allowing for trusts or LLCs that offer foreigners significant privacy and asset protection, often with favorable state tax treatment.
So foreigners are bringing money into the U.S. for the same reasons Americans might send it out: stability and asset protection.
Largely, yes. It's the security of the U.S. legal system, the strength of the dollar. For someone facing turmoil at home, that stability can be far more valuable than a slightly lower tax rate somewhere else. It's a flight to safety.
So for global investors, the U.S. offers predictability, rule of law.
Exactly. Plus, you get access to deep U.S. capital markets, diverse investment options you might not find elsewhere, and it can act as a hedge against your home currency potentially devaluing. These are legitimate financial planning strategies.
But we can't just gloss over the history. The reason for all this intense scrutiny and regulation is that offshore accounts were heavily misused.
No, you absolutely have to acknowledge that. Things like the Panama Papers leak in 2016 really expose how some individuals and corporations use complex offshore structures precisely for illegal purposes: money laundering, hiding assets, tax evasion.
And the scale isn't trivial. The UN estimates, what was it? Illicit financial flows make up something like 2 to 5% of global GDP.
That's the estimate, which translates to roughly $2 trillion US dollars. It's a staggering amount of money moving illicitly, which is why the crackdown on the legal side has become so intense.
Which brings us squarely to compliance, especially for Americans listening. What do you need to know?
Okay, for U.S. persons, the big one is the FBAR report of foreign bank and financial accounts. You have to file this with FinCEN, part of the Treasury Department, and the threshold is surprisingly low. If the total value of all your foreign financial accounts combined exceeds $10,000 at any point during the calendar year, you have to file an FBAR.
$10,000. That catches a lot of people, maybe someone studying abroad or with a small foreign investment.
It really does. And then there's FTAKE, the Foreign Account Tax Compliance Act. This is the game changer globally. FTAKE essentially requires foreign financial institutions, banks, investment houses everywhere to report information about accounts held by U.S. taxpayers directly to the IRS.
And if they don't comply?
They face serious penalties like hefty withholding taxes on their U.S. source income, potentially locking them out of the U.S. financial system. It was a powerful move.
Basically strong-arming the world's banks into becoming reporting agents for the IRS.
That's a blunt way to put it, but it's essentially yes. It shifted the burden onto the foreign banks.
Which explains why some banks just said, no thanks, we don't want U.S. clients anymore.
Exactly. The compliance costs and risks became too high for some, especially smaller institutions.
And there's more reporting needed if you have larger amounts, right?
Yes. If your foreign assets are more substantial, you also need to file IRS Form 8938, Statement of Specified Foreign Financial Assets, with your tax return. The thresholds are higher for this one, over $50,000 on the last day of the tax year, or $75,000 at any time during the year if you live in the U.S. They're higher if you live abroad, $200,000 and $300,000 respectively.
So multiple layers of reporting. The message is clear. Use foreign accounts legally if you want, but don't even think about hiding them.
That's the bottom line. Disclosure is mandatory and non-negotiable.
Okay, that covers the basics of holding a foreign account as an individual. But the sources also go into something more specialized. Offshore banking units, or OBUs. This sounds like where things get really technical, deep in the machinery of international finance. Here's where it gets really interesting.
It does get a bit more complex. Think of an OBU as a sort of special department or a shell branch of a bank. It's physically located in one country, often an international financial center like Singapore, London, or Hong Kong. But it operates under a special license, primarily focused on international, not domestic, business. So a big London bank might set up an OBU in, say, Delhi to handle specific types of international lending in that region.
Okay, a special license for international deals. What's their main function that makes them different from just a regular branch of that London bank in Delhi?
Their core activity is usually lending and taking deposits in the euro currency market. Now, euro currency is a technical term, and it's a bit confusing. It doesn't necessarily mean the euro currency. It means any currency held on deposit in banks outside of its home country.
Can you give an example?
Sure. U.S. dollars held in a bank in Tokyo. Those are euro dollars. Japanese yen held in a bank in New York. That's euro yen. British pounds in Frankfurt. Euro pounds. OBUs specialize in transactions using these pools of currency held outside their country of origin.
And why does that require a special unit? What's the advantage?
Flexibility. Because they're dealing in international markets with currencies not directly controlled by the host country's central bank, the local authorities often grant these OBUs significant leeway. They might face lower reserve requirements, fewer restrictions on interest rates, or other regulations that apply to domestic banking operations. This makes them more efficient for a large-scale international finance.
More flexibility. That sounds like it could cause problems for the host country's economy if not managed carefully. How do they keep it separate?
That's the crucial firewall. There's usually one very strict rule. OBUs are generally prohibited from dealing with local residents or conducting business in the local currency. So that OBU of the London Bank in Delhi, it cannot take deposits from Indian residents or make loans to Indian businesses in rupees. Its clients have to be other international entities or non-residents.
Got it. So it's ring-fenced. It operates in the country, but not as part of the domestic banking system. Its focus is purely external.
Exactly. Their clients are typically multinational corporations, other international banks, non-resident, high-net-worth individuals, entities engaged in global trade and finance. They're looking for sophisticated cross-border services, ways to manage currency risk, optimize tax legally on international operations, or access global investment opportunities.
And what kind of services do these OBUs offer beyond just the euro currency lending?
It's a pretty wide range tailored for international clients. Specialized deposit accounts, complex international wire transfers, foreign exchange services, syndicated loans, trade finance, wealth management, and often they'll help clients set up the necessary international structures, like offshore companies or trusts, that facilitate these global financial strategies, all within the legal frameworks, of course.
Given the international nature and, let's face it, the historical baggage of anything offshore, the regulation on these OBUs must be intense now.
Oh, absolutely. Forget the old secrecy ideas. Modern OBUs operate under very strict regulatory oversight. They have to implement robust AML, anti-money laundering procedures, and stringent KYC, know your customer policies. Plus, they are subject to the same international information sharing agreements we talked about earlier, things like the OECD's Common Reporting Standard, CRS, and FATCA. There's a global network exchanging financial data.
So CRS and FATCA apply to OBUs just like regular foreign banks.
Yes. That network really slammed the door shut on automatic bank secrecy for tax purposes. The example used in the sources is the 2015 deal between Switzerland and the EU. Starting in 2018, Swiss banks, including any OBUs operating there, had to begin automatically exchanging account information for EU residents with their home country's tax authorities. No more hiding.
It sounds like the key distinction now is between privacy and secrecy. OBUs offer regulated privacy, but not illegal secrecy.
That's the perfect way to put it. They protect client data according to strict rules, but they are legally obligated to report information to tax authorities under these international agreements. The system is built for transparency now, not concealment.
Okay, so let's try to pull this all together. What's the main takeaway from diving into all this material on offshore banking and OBUs?
I think the core message is this. Offshore banking, when done right, is a legitimate, sometimes necessary tool in today's globalized world, mainly for diversifying assets and seeking financial stability. But, and this is the crucial but, its legality hinges entirely on transparency and full compliance with your home country's reporting requirements. The whole game has changed.
Right. So while the name still conjures up images of spies and scandal, for most people using it legally today, it's actually, as one source put it, more mundane than it appears. It boils down to understanding the rules and filing the right forms, like the FBAR or Form 8938 if you're American. Tedious, maybe, but
Nope.
legal.
Exactly. Less James Bond, more TurboTax International.
So what does this all mean for you listening?
It means understanding the real drivers. While tax benefits get headlines, the sources strongly suggest that for many, especially those outside the most stable Western countries, the #1 reason to hold assets offshore, even if that shore is the U.S., is the search for political and economic stability.
And that leaves us with a final thought, something for you to consider. In a world that feels increasingly unstable, with geopolitical tensions and economic uncertainties popping up everywhere, is the ultimate safe haven not necessarily the place with the lowest tax rate, but simply the jurisdiction, wherever it may be, that offers the greatest perceived security, the strongest rule of law, and the most enduring stability? Something to mull over.